Should I start over? Okay, no problem. All right, starting from the top. So happy Wednesday, everybody. I am Travis Tang, the Director of SBA and Conventional Funding with Lexington Capital. And this episode is about SBAs versus traditional loans. SBAs being the government agency that backs business financing with more favorable interest rates, favorable repayment terms, and more lenient requirements and often higher approval rating. And then you have traditional loans, which has just been around longer, right? Think your Chase banks, your credit unions, your regional banks, your nationwide banks, right? Like Chase, Wells Fargo, US Bank. And so just, looking to compare and contrast them for you in a straightforward Lexington fashion. So you can be able to weigh the pros and cons, whether you're a small to medium-sized business owner, whether you're a loan broker like Lexington looking to help a small to medium-sized business owner, you're a business consultant, credit repair, any kind of business to business, industry you might be in where you are either an entrepreneur planning on getting funding or you're looking to help somebody get funding. This is going to help you, understand these different loan options better. And we're going to do like a co-main event, right? So the main event is SBA versus traditional loans. And then the co-main event is going to be full doc loans versus no doc loans via SBA versus traditional loans. So what I mean by that is with, financing small business owners, right? Think like, $1 million or less revenue, or maybe even $5 million or less revenue. These business owners, their average loan ticket will probably be closer to maybe, $200,000, $250,000. But then you have business owners that might be doing, $10 million plus per year annually. These business owners, typically wouldn't be applying for, small business loans unless they're going for dollar amounts, maybe closer to $500,000 on average, right? So now that's where you have your full doc loan, right? Where they're going to ask you for more paperwork, more financials, longer process, more collateral. And then you have your no to low doc loans, right? Where it's the opposite. It should be faster, more streamlined, less requirements, and then you get lower dollar amounts, right? So with SBAs and traditional loans, they have those two aspects within the different products out there, right? So that's the first thing we should cover. Now, availability. So we're going to do this webinar in a way where it's going to go category by category. We're just going to go toe to toe, right? And so first category is availability. So between SBAs and traditional loans, SBAs have not been around as long, right? So the SBA administration was established in 1953. If you look up traditional banks like Bank of America, US Bank, these banks have been around since the 1700s, right? So the traditional lenders win as far as just reliability. They've been around longer. They're here to stay. But SBAs have that novelty and that newness to them where it's a little bit more prestigious, right? A little bit more rare, a little bit more unique to have one. And it's a supply and demand thing at that point, because if you look into it, there's more banks, right, than SBA banks, right? But on the flip side, you would think there's more money available with traditional loans. But because these banks have been around longer, they have established books of businesses. They have more red tape most of the times to get approved. So SBAs, because they haven't been around as long, is actually probably easier to get access to. And a good example of it is just the banks that do SBAs are mostly nationwide, right? It's a universally available product in America if you qualify for specific parameters of an SBA program. But then you have traditional lenders where a lot of times it's relationship based. A lot of times you have to be local to that bank to even qualify. You need to open a deposit account, right? So you can bank with that bank, with a checking account or a saving account. A lot of banks will require you to actually have a certain amount of, guaranteed deposits that you're going to bring over, or if not your whole business, right? Majority of your business. A lot of, traditional lenders, can only do certain geographical locations regardless of a bank account, right? So this is where you have your SBA, which is, in my opinion, more available than traditional loans right now, but there is more traditional banks available and traditional loans have been around longer. All right. So SBA wins that one. And then we have aspect number two, right? We have dollar amounts. So with dollar amounts, you have SBAs where they can go up to $5 million on a SBA 7A or a SBA 504, which is your most common types of SBA loans. But then you have traditional banks that can go, and actually one more correction. If you're a manufacturing business, starting as a 2025, you can go up to $10 million on an SBA 7A or a 504 loan. So keep that in mind, right? 5 to 10 million is the max for an SBA. It's really 5 because not everyone's in manufacturing. It's just one industry, but that's your facts, right? Now you have traditional lenders where it can really go up to as much as the bank wants to do, right? You're not limited by a government SOP that's mandated across the nation of how much the max is. It's just a matter of you feel comfortable with that borrower, with the collateral that can be provided, or the cash flow, or the analysis, whatever the bank decides, works, can actually go through, because it's a licensed lender. They can drop the contract, they can underwrite it, they can, create their own loan sizes. So traditional lenders actually win when it comes to dollar amount. At Lexington Capital, we're dealing with the borrower and they need the best rates, they need the, longest terms, the lowest down payments, the least collateral, but they can't even get off the ground with their project unless they get over 5 million or over that 10 million. Then we just have to take them to a traditional bank, because it just wouldn't get the job done for the SBA. All right, so moving on to the next topic, we have the no to low doc SBAs and traditional loans, the amount, right? So we have to do a no to low doc versus a full doc side by side. So usually the no to low doc SBAs can range from any amount, really, generally from 25,000 up to 350,000. And then you have your traditional banks, which at Lexington Capital we typically see can lend from anywhere from as low as also maybe 10,000 to up to 500,000. And so traditional banks also can win this battle, where the SBA just has a strict SOP that every single SBA provider across the board needs to abide by. They just can't go over $350,000. That individual bank servicing the SBA might have their own conventional products over $350,000 for a no to low doc, business loan. But if you're going SBA, it's max $350K. If you're going traditional bank, you can possibly get up to $500K. Typically if you're going for a no to low doc type of loan. All right. So then now we're looking at next aspect. All right. We have your terms. Okay. Terms is just the length of payback. So SBA loans are famous for their 10-year terms, because, typically most other financing out there, say a credit card, which is usually a 1 or 2 year payback if you max it out, say equipment debt, which is usually a vehicle loan, which is usually a 4 to 7 year payback. You have your lines of credits out there, or term loans with conventional banks, typically a 3 to 7 year monthly payback. You have your alternative term lenders, online lenders, typically a 1 to 2 year payback. Then you have your SBA at a 10-year payback. So SBA wins that one every single time. It's going to be the longest term out there, meaning the lowest monthly payment. And usually the reason why a lot of people are willing to go through an SBA process, right, over the rest. The win. So it's 2-1 so far, right? So now we have interest rates. Interest rates are comparable. SBA rates are usually going to be prime plus 1 or more, and traditional banks should be the same. So, for that, I can say, very similar, but at the same time, traditional banks are more nuanced, right? SBA is cookie cutter. They're famous for their 10-year term, right? But then you might have a online lender that offers a 1-year term. You might have a conventional lender that offers a 4-year term. You might have a credit union that offers a 3-year term. So it's more varied. And because of that reason, it's the same thing with interest rates, right? So, SBA rates, if it's prime plus 1, right now prime is 6.75. So that's a 7.75 rate. Best case scenario, right? If you're, the best case scenario in SBA, prime plus 1, you might get like a 7.75, 8%. Now, traditional lending, you might also get the same thing, right? You're not really going to see lower than that, because it's always going to be prime plus a spread usually. But then at the same time, you might have a way larger range, right? A higher SBA rate might be like prime plus 3. So maybe you're looking at 8 to 10%. But then you look at traditional lending, you might get prime plus, 10, right? It might be prime plus 15. So now you might be looking at rates that can be as high, as low as 8 up to a 20% range. And so if we're looking at rates and we're going toe to toe, SBA wins that battle. So now we have it at a 3-1 score so far. All right. And we fully service SBAs and conventionals. We're being completely objective with all of these comparisons. All right. So the next thing here is the turnaround times. Okay. So this is one of the big ones. SBA, there's always a catch to things, right? So far SBA is winning 3-1, best rate, longest term, lowest payment, even more availability, more access, but they typically will be always longer, right? And so the reason why is, any SBA lender, is a lender first before a government. They're not a government entity, right? They're just using the government to guarantee the loan. So just think of it like this. If you're a conventional lender, say Wells Fargo, and you need a tax return, a bank statement, a driver license, an application, right, to submit for a loan. And SBA, if Wells Fargo decided they have to go SBA, maybe it's too risky, so they need to use the SBA to back the loan, it's going to be the same document request, but you can just add 3 or 4 or 5 on top of it. And so because of that reason, SBAs usually just take longer, right? More paperwork to process, more time for the client to have to work on the documents, to gather stuff, prepare stuff, get in contact with CPAs. And if you're looking at an SBA, full doc loan, you're probably going to be looking at a 60 to 120 day process to finalize funding. If you're going traditional for a full doc process, again, backtracking, right? These are the loans where they're going up to $5 million, up to $10 million. Traditional, going to as much as you want. You might be looking at a process of 1 to 3 months, right? So you're looking at 3 to 6 months versus 1 to 3 months on a full doc SBA versus traditional loan. And then let's say you're going for a no to low doc SBA loan, that typically would be a 30 to 45 day process. But then if you go to a traditional bank that's not going through SBA, you might be looking at a 1 to 3 week process, right? So now you're looking at a month to a month and a half to a couple of weeks to a month at worst case scenario, right? Or less than a month. And so SBAs lose that battle. It's 3 to 2 now, right? So traditional loans will be faster. There's going to be a higher payment, probably going to be a higher interest rate, and you might spin your wheels a little bit trying to find the right bank because they're just not as accessible, typically as an SBA that's a nationwide, non-relationship based, product. All right. So now we have docs required. All right. So, if you're going full docs, the docs you should expect to have is to be required, would be things like, 3 years financials, right? If you're going for dollar amounts that are over, 6 figures, 200,000 plus, $300,000 plus, $400,000 plus, you're typically going to always have to require at least 3 years of tax returns. So that includes business taxes, that includes personal taxes, that includes year-end financials. So, the year of 2025 just ended. They'll have to provide a whole entire profit loss balance sheet of that year. And then you'll typically also have to provide what's called a year-to-date financial of 2026, right? So let's say, 2025 ended, but then since the year started, you took out new debt, your income has been really low or really high, your expenses have been really low or really high. These kinds of things definitely matter. So you need to definitely submit that up front for a full doc package. Those are some examples. So year-to-date, year-end profit loss balance sheets. You're gonna have to do debt schedules, itemizing, summarizing what the business owes, whether it's a existing SBA loan, traditional loan, equipment loan, commercial real estate loan, line of credit, credit card, invoice factoring, right? So that's pretty much the majority of the types of business debt you could have. Then you'll have other documents like formation stuff, right? If you're a corporation, your articles of incorporation. If you're a sole proprietorship or LLC, your articles of organization. If you're a business that requires a license in the state, county, or industry that you're in, you'll need to provide business licenses, right? Proofs of ownership, EIN letters, and that's any kind of full doc, loan would need that. SBA, traditional, and just keep in mind, right? If you're going to SBA, it's always going to be the same exact package, but typically a couple of additional documents required. All right. So for docs, for full doc, that's your full doc deal. Then for your no to low doc deal, right? If you're going SBA, your typical, worst case scenario will be, 2 years of taxes, personal and business, 6 to 12 months of bank statements for the business, last operating months, forms of identity that are active, driver license. You're going to need, the personal financial, the personal financial statement, the business debt schedule, a lot of the basics, but you would be able to get away with not doing profit losses and balance sheets for a no to low doc loan if you're going below 350K. And so that's your SBA, right? And then you have your no to low doc traditional loans, pretty much the same thing. But the big difference for this is they usually ask for different docs, like maybe a insurance document. SBAs, typically anything over 50K requires a business personal property insurance policy. And a lot of business owners don't have them, or they don't have a policy that ensures enough of the updated asset value of your company, right? So business personal property insurance is essentially is insurance for the property that the business owns. So what would be considered property of a business? That can be, the equipment, the machines, the vehicles that the company owns, the inventory, the tools, supplies, right? Stuff that's worth, more than thousands of dollars. And so business personal property insurance covers that. So then the lender, for an SBA, a lender would want that because they would want to be listed as a certificate holder. That means that if that insurance, if that loan, if something happened to the business and those assets got affected, the value of it went down, the vehicle got crashed and, it got totaled, the inventory got burned away, whatever the case. This way, as the business value will go down, the SBA will get at least reimbursed. So this way, whatever collateral they might have had on the loan will be covered, and they're still able to be, covered for the loan they provided, right? So these are usually not required for traditional loans that are no to low doc, but they are always required for SBA loans that are, no to low doc, right? So this can sometimes be a deal killer because this is a monthly, policy. You got to provide a premium. You got to go on. You got to put down payments. So it's an extra process. It might not be that, expensive in the grand scheme of things. It might be like $50 a month, $100 a month, but time kills all deals. And that extra week or two to get extra paperwork to follow up with insurance agents can kill your deal, where you just might lose the opportunity, right? If you need the money for payroll, if you need the money for an opportunity, something you're trying to buy on discount, competition, you're trying to buy out, or you just don't have faith, right? Like a lot of people just don't have faith. That's why people love Uber Eats and DoorDash, right? They just don't want to wait. The luxury of being able to pay more so you don't have to wait is a real thing. And sometimes, it's just worth it for people, right? So that's your no to low doc and full doc for SBAs and traditional loans. Very similar paperwork, but just that's your rule of thumb, right? Whatever the SBA, the traditional loan would need, SBA would need the same exact thing, plus maybe 30% more every single time, which is why you have that slight gap, right, in turnaround times. So the winner for that one will be the traditional, lender. So now we are at 3-3, right? It's a tie. So we're going into the home stretch. All right. So we have products. Okay. So products for your SBA, you have your 7A, you have your 504, you have EIDL, you even have CDC loans, which is, backed by nonprofits going through SBAs. So let's just do each one really quickly, right? Let's start off the CDCs. Let's go from least relevant to most relevant. So CDCs are least relevant. These are loans that are just, for people that aren't unqualified, but they have real businesses, real stories, real business plans, very similar to SBA 7A, where it's low interest rates, long terms, monthly payments. And this is just a little bit of a different process and maybe a little bit less available because this is a nonprofit company that will be administering this for you. All right, so keep that in mind. It's your CDC. You have your EIDL. This is a program that's designed specifically for disasters. All right, so if your area, your county, your city is affected by a disaster and you can prove that your revenue dropped during that time period, you would qualify for EIDL, where this is the best loan in American history. You're looking at a 30-year term at a 3.75% interest rate, and you can't really beat that, right? That's better than most mortgages, and we're talking about unsecured business financing. So that's your EIDL. You only qualify during disasters. Most people never heard of it until COVID. That's when the most people ever got access to it, because pretty much everyone went through a disaster at that point. But nowadays, you really see it more for people that are like, let's talk about like the LA fires, California fires, South Carolina, North Carolina hurricanes, Florida hurricanes. There are people in those areas that will qualify probably right now for EIDL financing. And then now you have your 504. This is the SBA loan that's meant for real estate based SBA. So let's think of it like a construction project, ground up, apartment complexes, where it's going to be a long drawn out situation. There might be draws in between, right? You fund one round, fund phase 2, fund phase 3. You have your SBA 504s, and then you have your SBA 7A, right? Which is the most popular, most common, most, household name. This is a multi-purpose loan, which you can use for working capital. You can use for debt refinance. You can use for buying real estate. You can use for buying equipment, machines. You can use it for pretty much anything, right? You can use it for leasehold improvements, improving the building of your business. If you want to make some renovations, that's your 7A. Back to the 504 as well. Any kind of real estate with SBA needs to be owner occupied. All right, that means that the business getting the financing needs to operate out of the location. All right, so this is a big difference, because now we talk about traditional loans, right? So traditional loans, they have loans for all of those things, right? They have equipment loans, they have lines of credit, they have term loans, they have construction ground up, they have fix and flip, they have cash out refi, they have all of it. But in this case, the only thing they have that's a little bit different than SBA is that they can do real estate for businesses or holding companies where it's not owner occupied, right? It can be a passive rental, right? You can build out rentals to people. With SBAs, you can't necessarily do that because you need to be occupied out of the property, right? To build the business. So usually, traditional lenders will win in that aspect because they can do more with real estate. But the winner for this category, I would say, would be SBA because of the fact that you can use SBA for multi-purposes. All right, so let's talk about the 7A again. So let's say you're going for a purchase of equipment. You need to get, let's say a trucker, you need to get a $100,000 truck. Let's say you also need to stop renting, right? You've been renting the last 20 years, so it's time to own the place, right? You park your truck, right? So you don't have to pay someone else's mortgage. So you want to buy the warehouse that you can park the truck for $1 million. Right now, your loan size is at $1.1 million. Let's say you also need $350,000 working capital to hire more drivers, put more advertising out there to expand the business, right? Now you have a $1.45 million loan all within one program, the SBA 7A. With traditional lending, that's way more uncommon. Most traditional lenders are cookie cutter in the sense that you have to apply for specific programs, right? If you apply for an equipment line of credit, you're not going to be able to buy commercial real estate within that, right? If you apply for a line of credit with, TD Bank, you're not going to be able to, if for working capital, you're not going to be able to refinance that on top of that or finance a machine on top of that, right? And so as far as products, SBA would win because you can use the money for the same exact stuff, but way more flexibility, way more creativity, and you can get the bang for your buck. Imagine you're going through a 60-day, 45, 90-day process and it doesn't cover all your needs and you got to reapply again. That would be a nightmare for a business owner. And that's what SBA does for you. It just, makes being a business owner a little bit easier, and it's a support for a small business owner. And so that's pretty much, the summary of this webinar. Your SBA versus traditional loan. You got all the pros and cons. The final score ended up being 4-3. All right, in this objective session that we had. So thank you all for joining. And if there's anything that you want us to talk about for the next one, just drop a comment. And if you or anybody you know can benefit from more information, from physically applying to get financing, planning ahead, preparing, it'll never hurt to reach out to Lexington Capital Holdings. You can find us online, our website. We're here for you all.